Wall Street doesn't want you to know this, but there's a simple, boring index that beats almost every professional investor over time. It's called the S&P 500, and it might just be the most powerful millionaire machine ever built. Here's the twist. Over the past 30 years, the S&P 500 has returned about 10 to 11% a year on average. Meanwhile, more than 85 to 90% of professional fund managers, the people paid millions to pick stocks, underperform this one index. The scoreboard wins. Most players lose. And yet millions of everyday people still hand their money to managers who usually trail the index they could buy for pennies on the dollar. So what exactly is it? The S&P 500 is not a stock you can buy. It's an index, a tracking method for America's 500 biggest companies. That includes tech titans like Apple, Microsoft, Amazon, and Nvidia, healthcare giants like Johnson & Johnson, financial powerhouses like JP Morgan Chase. Together, they make up about 80% of the entire U.S. stock market's value. You can't trade the index itself. It's just a measuring stick. But here's where the magic happens. Different fund companies created mutual funds and ETFs that track it, so you can own the market itself with a single investment. The S&P 500's history is the story of investing's biggest revolution. In 1957, the index was created. In 1976, Jack Bogle launched the first index mutual fund. Wall Street mocked it as Bogle's folly. In 1993, SPYI, the first ETF, made the S&P 500 tradable like a stock. And in the 2000s and 2010s, cheaper and smarter versions arrived: VOO, IVV, RSP, SPLV, and now SPYI. So what about mutual funds versus ETFs? Both can track the S&P 500, but the way they work and how you use them is a little different. Mutual funds, like Vanguard's VFIAX or Fidelity's FXAIX, charge rock-bottom expense ratios as low as 0.015 to 0.04% a year. For every $10,000 you invest, that's just $1.50 to $4 in fees. They often require minimums, sometimes $1,000 or $3,000. But they shine in retirement accounts like a 401k or IRA, where you can set up true auto investing straight from your paycheck. You never even have to think about it. ETFs, like SPYI, VOO, or IVV, are also very cheap, with expense ratios around 0.03 to 0.09%. Unlike mutual funds, there are usually no account minimums, and you can buy even a fraction of a share in most brokerage apps. ETFs trade like stocks during the day, which gives you more flexibility. But here's the catch. In a 401k, you usually can't auto-invest directly into ETFs the same way you can with mutual funds. You can auto-deposit cash, but the ETF by itself may still need to be placed manually, unless your broker or robo-advisor does it for you. Bottom line? Mutual funds are best inside retirement accounts if you want pure autopilot. ETFs are best in brokerage accounts if you want flexibility. Either way, both are dirt cheap compared to active managers, and both crush 90% of Wall Street over time. And here's where it gets even more interesting. The S&P 500 is no longer just one product. It's a family of products tailored to different goals. Let's compare. Classic funds like VOO, IVV, and SPY give pure S&P 500 exposure. Expense ratios around 0.03 to 0.09%. Annual returns of about 10 to 11% over the last 30 years. Dividend yields around 1.3 to 1.5%. Best for long-term growth at the lowest cost. RSP, the equal weight version, gives every company the same weight, so Pepsi counts as much as Apple. The expense ratio is about 0.2%, returns about 10.2% annually since 2003, but with more ups and downs. Dividend yield about 1.5 to 2%, best for investors who want balance across big and small companies. SPLV, the low volatility version, focuses on the 100 least volatile stocks in the S&P 500. Expense ratio around 0.25%, returns about 8 to 9% annually since 2011. Dividend yield about 2.5 to 3%. Best for investors who value smoother rides. And SPYI, a newer high-income ETF, sells covered calls on the S&P 500. Expense ratio around 0.68%. It delivers 7 to 10% in income yields, but caps some upside growth. Best for investors who want cash flow today. When people say the S&P 500 has averaged about 10% a year for decades, that number actually has two parts. Capital gains, price growth. Around 6 to 7% a year comes from stock prices rising as companies grow, innovate, and make more profits. Dividends, cash payouts. Historically, another 2 to 4% came from dividends. In the early decades, yields were closer to 3 to 4%. Today, they average around 1.3 to 2% since stock prices have risen faster than payouts. And here's the secret weapon: reinvesting those dividends. When you reinvest, your dividends buy more shares, those shares produce more dividends, and the snowball grows. Over the long run, dividends and reinvestment account for about 30 to 40% of the S&P 500's total return. That means almost half of the growth came from money companies paid directly to shareholders. Meet Alex. At 20, Alex sets up Auto Invest, $500 every month into the S&P 500. At 30, Alex has about $102,422. At 40, it's $379,684. By 50, Alex crosses $1,130,243. Here's the incredible part: Alex only contributed $180,000. The other $950,000 came from compounding. Alex didn't trade. Alex didn't guess the next Tesla. Alex didn't need luck, just patience. Warren Buffett once said, "For most people, the best thing is to own the S&P 500 index fund." He even directed 90% of his own estate into it. If the world's greatest investor trusts the index for his family, why wouldn't you trust it for yours? So here's the choice. Keep chasing hot stocks and hype, or quietly build millionaire status while you sleep. One index, 500 a month, a future worth more than $1 million. The millionaire machine is already running. The only question is, are you on it? Start early, think sharp, learn right. That's your clear path.